In this video, we're going to talk about MULLEN, trading under the ticker symbol MULN. MULLEN has been an interesting stock to cover and trade over the past few months. It has had its ups and downs over time, and its volatilities are absolutely massive. Being on the right side of them can bring very handsome returns. The question, of course, is where will the volatility go next? Recently, MULLEN stock tumbled around 30 cents, with the stock rumored to go through another round of reverse stock split as well as ongoing lawsuits against the brokers. So far, the efforts have not really yielded any significant upward momentum for the company, and for many, time is quickly ticking out. Even though when it comes to a penny stock like this, it's never a question of how high or low it can go, but when such a move may occur. MULLEN is mostly flatlining at the moment, with clear indications that the capital and volume are looking elsewhere for better opportunities. But that doesn't mean that the stock will never be trending on our shortlist ever again. I think that MULLEN will be able to make a big score the next time our collective mind is convinced that a company is about to make a big uptick for either rational or irrational motives. Right now, we're not seeing this getting foamed up anywhere, so we must not operate with this kind of assumption just yet. Let's also take a look at the technicals. The trading volume of MULLEN has recently been around 125 million shares, compared to an average volume of 36 million shares. Over the previous 52 weeks period, the price fluctuated between 39 cents and $122.32. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, if there's enough liquidity to support a trading strategy. If the float is thin, it will be very easy to influence the price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be a possibility for the trend reversal or breakthrough if the volume is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of MULLEN is currently around $48 million versus the enterprise value of $17.3 million. So, as we compare the current price to the historical price fluctuations, the stock is 42% higher than the 1-month low, 42% higher than the 3-month low, and 42% higher than the 52 weeks low. On the options market, which gives us a hint about the market sentiment on where the stock might go next, the implied volatility is 314% compared to the historical volatility of 165%. The put-call volume ratio is currently at 13%. It's normal for many stocks to have a higher put option volume than what they deserve, as many long positions are hedged. The most recent volume of options traded is 35,000 contracts versus the 30-day average of 14,000 contracts. Regarding the open interest, the most recent volume of open interest is 918,000 contracts versus the 30-day average of 1 million contracts. Regarding the shareholder structure, institutional shareholders own 8%, likely as a result of short selling of its outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. Usually, it's better to see some institutional participation for holding a stock long-term. Although in the case of MULLEN, I would say that long-term is not exactly the place you want to be as far as this company is concerned. I personally am not sure if you're going to see MULLEN around 5 years down the road. We're mostly talking about the short term or the medium term for the time being. The current short interest is 29% of the total float, 60% of which from the dark pools. So usually if there's 15% or more short interest, then at some point we may be able to argue that there is some sort of a short attack going on, and that there could be potentials for a short squeeze. So right now, the global markets are facing a complex interplay of factors. that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. My recommendation for Mullen is to wait for the stock to first stabilize itself and possibly aiming for recoveries to higher levels. We should never rule this possibility out, so keeping it on our short list is always a decent choice. I would recommend to commit between 0.5 and 1% of your portfolio on Mullen overall.